Hello and welcome to episode 345 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leakes. Damien, welcome back. Well, to start this podcast, we've just done a bit to camera actually to send out on Instagram stories because you've been all over that lately. But today especially, you've had an update for the people who check out our Instagram channel. What's been going on?
Well, I've put my back out, Andy. So I'm standing. We're doing the podcast standing up, and occasionally we do it because we've got one of the tables in the office that can electronically rise up. And I've managed to put my back out while getting dressed after getting out of the shower. And I was rushing to get to a meeting. And yeah, I put my back out trying to put my pants on, which is just the most ridiculous thing ever. I know it's probably oversharing, but yeah, if you go onto the Instagram stories, I'm doing loads of Instagram stories now. So people have asked me to do more on social media and about what we get up to. And actually now I've started, I can't stop. It's like you open up the floodgates. So I'm actually doing things about money on there, sharing content, just sharing things that are going on in my life or the life of Money to the Masses. So do follow us on Instagram and in particular stories. That's where I'm taking over control and put stuff on there on a daily basis. And some of it is just nothing to do with money actually, but there's quite big chunks that are. So yeah, Andy is going to be editing this podcast beautifully. So my groans are taken out because I'm on painkillers as I stand here doing this.
Talking of editing, actually, I'll put it out there because we are recording slightly later because of Damien's unfortunate situation. We're recording this over a lunchtime and we work in a busy office and people are to and fro-in. So you might hear the odd bang and hey, the show must go on.
Yeah, the show must go on. The bang will be Andy heading out to get his Nando's. We've just ordered Nando's into the office because it isn't Bronte's birthday today. It was Bronte's birthday this week. So we always celebrate in the office by ordering in the birthday person's favourite takeaway into the office, and Nando's seems to be the takeaway of choice in this office. So so we're going to be listening for our Nando's to come in. But anyway, I'm going to tell you what's on the podcast this week, Andy. We've got three pieces as usual. We've got Harvey on the podcast this week, a nice piece on terminal illness benefit. It's off the back of a news story of people who were hoping to get a terminal illness benefit from basically the Department of Work and Pensions and are dying before they even get that. So they've got a terminal illness they've been diagnosed with, wanting some support. But Harvey wants to talk about the terminal illness benefit that you probably have and you don't realise that you've got if you've got life insurance, which could help people financially in that situation. The other piece I want to talk about are junior ISAs. So it's a topic we've touched upon before, but I feel it needs a little bit of updating because there's been one or two innovations, but more importantly, it's topical because we've just had the 10th anniversary of junior ISAs. So I want people to engage with the idea of junior ISAs, something that I've done personally over the last year, and I think it's incredibly powerful. And the final piece is about climate change. So if you want to do your bit for climate change and you're frustrated by what you've seen going on at COP26 in Glasgow and about temperature targets, there now is a new way in which you can analyze your investments and choose companies that do in fact invest in line with those global targets on temperature rises. So you can see the good and the bad. So it's a very short piece, but I think it's one which a lot of people will find useful and empowering.
Okay, so let's start with junior ISAs. And Damien, you said it's something that you've recently engaged with as well. And as they turn 10, it seems the perfect opportunity to talk about them a little bit more and give some insight.
So go back to podcast 244, where I did a whole piece about junior ISAs. This is a little bit of an update on that with some more information which people will find useful. Now, on that podcast, I talked about what junior ISAs are, but just to quickly recap, they are a product that you can use to save for your child's future or invest for your child's future. They actually get to own it at age 18. So when you open them as a parent, only parents can open them. You can put currently £9,000 a year into them. And that money can go into a cash junior ISA, for example, where you can get the savings rate. I'll come on to the best saving rates in a moment. Or you can invest in a stocks and shares junior ISA, which means that you can invest in funds, which means that you could try and grow the money you put into the junior ISA by taking more investment risk. So, of course, the capital is at risk when you do that. And the key thing is that as a parent, you do not have access to any money that goes into a junior ISA. Once it's in there, it's for the benefit of the child and it becomes theirs at age 18, whether you like it or not. And of course, the other benefit is that grandparents and other people can pay into a junior ISA once it's set up by the parent. So it's a great way of starting to invest or build a pot of money for a child's future. And the benefit of compounding means that you can obviously grow a sizable sum over time. Now, if you do nothing else this weekend, go back and listen to our Millionaire podcast episode where I talked about junior ISAs quite a bit in that episode, and it was empowering to people. It's one of our most popular episodes we've ever done. We'll link to it, where I actually told people how little money they can end up having to put into a junior ISA, for example, every month, and they could end up making their child a millionaire in later life. And it's incredibly empowering. So we're going to link through to that show. So that's why you would want to engage with junior ISAs. And as I said, they're 10 years old now. So for me personally, I engage with junior ISAs. I have junior ISAs for my children, and I don't put in large amounts of money. It's more about doing regular small amounts that can grow over time. And then I choose the investments that the stocks and shares junior ISAs that I use are invested in to try and maximize those potential returns. Now, I'm not going to tell you the underlying investments that I have, but what I want to do is firstly go through some of the options out there in the market, because there have been some nice innovations in the junior ISA market that should get people even more reason to look into them, even if they only start by putting in, say, £5 a month. It all mounts up over time. But then I will go on to talk about some of the historic numbers that have come to light from Interactive Investor. Actually, they did some research and released some details of typical junior ISA portfolios and what's been happening with their junior ISA customers. So you might get some insights there on popular funds to invest in. It's not a recommendation, it's not advice, but you can see what other people are doing. So it is useful in that regard. So let me just start with the best junior ISAs. Slightly dates the podcast, but it's still important to do. So if you want to just invest in cash, you don't want to put the capital at risk, then you can get around about 2.5% on a cash junior ISA. Now, the top 4 or 5 pay 2.5%. Most of those are building society, so things like Darlington Building Society. We've got an article on the website which we'll link to that covers all of the stuff I'm about to talk about in terms of the best junior ISAs, cash ISAs and junior stocks and shares ISAs. And then you go 2.5% is the best rate. Then you go down to like NS&I, which is the National Savings and Investments. They pay around about 1.5%, as do most high street banks. So it's not great. If you're putting money into a junior ISA over time at 1.5%, the buying power is going to be eroded by inflation, because inflation, as we know, is targeted to be around 2%. At the moment, it is obviously higher than that. So assuming that you're happy with a cash ISA, then you can start putting money into that. Now, if you're wanting to look for junior stocks and shares ISAs where you can put in small amounts of money, because some of them do have higher minimums that you might have to put in a minimum of 50, say £100 a month or something like that, then you can invest with Wealthifier with £1. Wealthsimple have no minimum. Hargreaves Lansdown is £25 a month minimum. Interactive Investor is a similar amount, or you can put in any lump sum. Now, if you're looking for low charges, then again, things like Wealthify, Vanguard are attractive options, but there is a real standout out there at the moment, and this is where the innovation I mentioned came into it, because historically with platforms and also some of the robo-advice companies, the junior ISAs are seen as this kind of small, unimportant product in a way. They're there because they exist, people might want them, but because they couldn't accrue large sums of money under their management on those platforms, because the allowance limit at the moment is £9,000, but it used to be much smaller. So companies weren't that innovative or interested in trying to acquire assets under junior ISA wrappers. They'd much rather you give them your stocks and shares ISA portfolio or your pension. But Fidelity currently have decided to scrap their platform charge entirely on their junior ISA, which effectively means that you can run your junior ISA through Fidelity for nothing. And when I say nothing, that's the platform fee. You've of course got to pay the underlying fund charges that you invest in. That's true of any platform. But that is a real innovation. That's something that's very different, that they're actually trying to cut costs. And thinking about it, junior ISAs are a very long-term investment. Then, especially if you really get into the idea of that Millionaire podcast, then having no platform fee is a real bonus. So that's obviously one to look at. Now, typically the annual charges vary between, say, 0.6%. You can get as low as 0.25% with people like AJ Bell, but then they will be dealing charges if you want to buy and sell things within it. Vanguard is 0.15%. It's a max charge of £370 a year. No dealing charges. But again, it's Fidelity you come back to because they don't charge for their junior ISA accounts and they don't charge for any fund trades on there as well. The minimum is £50 a month, so a little bit more than some of the others, but it's not too crazy. Now, one of the other things I just want to quickly mention before we move on to talking about some of the stuff from Interactive Investor is that the difficulty you have with a junior ISA is you might set it up as a parent and it'd be quite nice if other people pay into it for you. So say grandparents or friends. But the logistics of doing that is normally very difficult. It normally someone has to involve you as the parent, even after it's been set up for some time by you. Now, that is a bit of a pain, but Wealthify are just about to launch a initiative or a feature which I've seen actually and had a play around with, which is quite nice, which is going to allow people to pay into a junior ISA on behalf of their, say, niece, nephew or friend's child and pay into it via an online portal themselves. They can do it online. So they wouldn't even have to engage the parent if they didn't want to. So you could be a grandparent deciding you wanted to put some money in. You could do it ad hoc, you could do it regularly. And I think this is nice because it's starting to open up the idea that people can make gifts into them, which is quite a nice idea if you're leading up to things like Christmas or anything like that, if you wanted to do something a bit different. But these innovations are happening in the junior ISA space. And I think in the past, people were quite reticent about the products. They were clunky, expensive, not much option in terms of funds. But now that has changed.
That's really good. We've been waiting for this for a while because there are children's savings products and apps that you can use, things like Go Henry, that encourage children to be able to budget and spend and save using their own cards. And a neat feature on one of those types of services is you can send gift links out to friends and family, so they can send money to the children, whether it's their birthday or Christmas. And this is kind of taking that element of it and bringing it into sort of junior ISAs. And I think that's great.
I like the idea of it because people don't realise that grandparents do sometimes want to be able to just autonomously just put money into an investment, or they may have some money they want to give for decent reasons. It could be inheritance tax reasons. They're actually deciding to give away some of their money and they want to give it directly to their grandchild without involving the parent, because if they give it directly into the junior ISA, it will go in there for the child's benefit and the parent doesn't have access to it. That's not because they don't like the parent, it's just because that's what their wish is. They want it to be for the benefit of the grandchild. I quite like it. Now, moving on to what's going on with the Interactive Investor research. What's quite interesting, they pulled some numbers and bits and pieces together and they found that after 10 years of junior ISAs, they did have some pots that were valued as much as £100,000 where people have been putting the money in over time. Now, some of those will have started as child trust funds. Now, they even mentioned that one lucky junior ISA account holder has enough to technically buy the average UK detached house, which is, I find, quite astounding. But really what that person has done there is put money in, probably maxed out their allowances over time, and then really engaged with the investment process, like I was talking about in that Millionaire podcast. Now, the top 3 most held investments in junior ISAs that have over £50,000 in them in total is the Scottish Mortgage Investment Trust. That's well known out there. I think it's been very popular because it did really well because it had growth stocks in it, technology stocks. Fundsmith Equity, another popular choice among investors. Again, that has some technology exposure in it, run by Terry Smith. It's quite a concentrated portfolio deliberately. And the other one is the F&C Investment Trust. Now, I think some of that, the F&C Investment Trust, I don't know, but some of that could be legacy because F&C were a very big player in the old child trust fund market. Now, if you go down to slightly smaller size portfolios, then again, it's the same funds that are appearing, but there is another one that's starting to appear, and it's the Vanguard Life Strategy 80% Equity Fund, which you would kind of expect. Now, I'm not going to make too much of a comment on there. I don't want to make a personal recommendation, but put it this way, that doesn't surprise me personally that it's in there. So in theory, if you did it through Fidelity, you wouldn't even have to pay the platform fee if you did it via Vanguard, for example. So there's some interesting bits of information there that you can take it, do with it as you will. None of it's advice, obviously, as with anything on this show. But junior ISAs, 10 years old, I think if you haven't engaged with them, then perhaps it's something you should start to do this weekend. And the other thing I love about it is the idea that it's paying your children first. We talk about paying yourself first. You set it up as a direct debit that comes out of your account each month, and you're paying your child probably ahead of all of your bills, a small amount of money, and it does start to build up over time and compounding. So do engage with it, and do look at the links that we're going to put in the show notes of this show.
Okay, so let's move on to the next piece then. And we're going to be welcoming Harvey back to the show, who's going to be giving us some insight really around something that she's quite passionate about. And so, Harvey, welcome back to the show. What are you here to talk about?
Hi, Andy. Thanks for having me back on. So yes, Damien and I were talking about an article that we both read that was published by the BBC earlier this week. And what it did was it tackled this situation that people who are unfortunately at the end of their lives are facing when it comes to claiming benefits through the Department of Work and Pensions. So the article had quite a stark headline and indicated that 100 people had died this year whilst fighting for this terminal illness benefit through the Department of Work and Pensions. What the benefit essentially does is it enhances benefits that the person might already be in receipt of, and if they're not already in receipt of them, it also fast tracks those benefits to that person, given that they're at the end of their life and they probably need a lot of financial support. And those benefits include personal independence payments, sometimes referred to as PIP payments, ESA, which is employment support allowance. So if you're in receipt of that and you find yourself in this situation, that can be enhanced as well. And universal credit. So universal credit payments can be fast-tracked and enhanced in that kind of awful situation. What in reality seems to have happened is that many people have died before they've actually realised these benefits through the Department of Work and Pensions, which is an awful thing to read and saddening in many ways as we see people struggle at a time when they should really be at peace and dying with some dignity and not fighting these kinds of battles.
Yeah, I read this article too. And Harvey, we've worked together in the protection industry looking at things like life insurance, critical illness benefits. So this isn't new to us, but you and I both looked at it and were sort of startled by what's happening and kind of shaking our heads really. It shouldn't happen. What seems to be the problem here? What's causing this kind of blockage?
Essentially, it's not a new story because we've probably seen these kinds of stories in the past and they're kind of resurfacing. We have problems in certain areas of benefits through the Department of Work and Pensions where perhaps sometimes the assessment process isn't supporting the person who's going through the process as it should. So the article very much revealed instances where the assessment was perhaps portraying people who were quite clearly at end of life stage and very frail as perhaps better than they actually were. So, not trying to paint that in too pure a light, but, there's no skirting around the issue that they were looking at people who were severely underweight, were clearly end of life and couldn't make decisions in their favour.
And is this because doctors are almost not too scared to, but they're reticent to kind of sign a piece of paper because in reality they don't know when that person is going to pass away, and so sometimes they're just being a bit they're holding it back. They feel worried about committing to something.
Yeah, in part of the assessment is that a medical professional would have to indicate that that person had less than 6 months to live. That's the criteria for fast tracking the benefit and enhancing the benefit that the person would receive. But also there is a certain amount of assessment that's done through the Department of Work and Pensions, and that perhaps isn't being as fair and as realistic as it could be through the article's findings. And that's where we could see the alignment, Andy, you and I, with a benefit called terminal illness benefit that we've worked with for several years. And we can see the crossover in terms of the struggle in getting this type of benefit and perhaps something that might help people in this situation.
Okay, so terminal illness benefit, you mentioned it there, Harvey. It is a benefit that you can have with a life insurance policy. So explain how it works. I mean, it's different for different insurance companies, but in the main, what are we talking about here?
Yeah, so terminal illness benefit usually escapes most people when they buy life insurance. So if you have a life insurance policy or you're about to purchase a life insurance policy, do just check. Most reputable insurers, when they provide life insurance, will include something called terminal illness benefit. Most insurance brokers, most insurance companies don't point it out because it's a peripheral benefit that exists within your life insurance. But in these kinds of circumstances, it can be extremely valuable. So what it allows you to do is it's allowing you to claim your death benefit early in a roundabout way. So if you find yourself in a situation where you're terminally ill and you've got less than 12 months to live, so 12 months being quite different to the 6 months that the Department of Work and Pensions requires, it's doubling that time period. If a medical professional can indicate that you've got less than 12 months to live, you would be able to go to your insurance company and say, I'd like to claim on the terminal illness benefit within my life insurance policy and take my death benefit early. And that in itself can help a person at that stage of their lives to avoid the kind of financial struggle and financial worry that that situation brings most of the time. But you've also got to bear in mind that the death benefit then isn't payable upon actual death.
Right. So it's like an early payment as opposed to an additional benefit.
And something that's quite critical and important to look at is the work that's happening in both of these spaces. So with the Department of Work and Pensions, we see that MPs are lobbying for that time limit to be scrapped, essentially, because it's stopping payments reaching people in these situations. But also in the insurance industry, in the life insurance industry, we're seeing a similar appetite to get rid of these time limits. So there's a company called Guardian 1821, and they have looked at doing away with the 12-month time period that was usually applied to this kind of benefit. So you would have to have a medical professional say that you were unlikely to survive beyond 12 months. And they've now said that if you have stage 4 cancer, motor neuron disease, CJD, or a number of Parkinson plus syndromes, that you would automatically qualify for terminal illness benefit, regardless of whether a medical professional could put that time stamp on your condition and the predictability of your lifespan. It's also worth noting, Andy, that in situations where people claim this death benefit early, sometimes they worry that if they do live beyond that time period, that they might have to return the monies. And that's another thing, we can clarify, is that once the payment is made and you have your terminal illness benefit, they can't claim it back. It's a very unpredictable sort of situation. So if a doctor says you're unlikely to live beyond the next 12 months, if you do live beyond the next 12 months, the insurance company aren't going to come back and look for their money.
Yeah, really what we want to do in this piece is highlight not only the fact that that terminal illness benefit is there for people to use, it's really to shine a light on the insurance industry and say, look, they're not trying to get out of paying out claims. They're not in the business of doing that. They actually want to pay out claims that are correct and within the policy terms and conditions because it's good for them. They're able to then promote that they pay out 98, 99% of their claims. And generally, the 2 or 3% that they don't pay out, there's a reason for it. And you can dig into the details. In fact, we write articles about claim stats with insurance companies. So let's finish off this piece then, Harvey, with explaining why this benefit is so useful. What can people use it for? Why is it so important to get it?
I think a lot of this, Andy, goes back to the notion of dying with dignity. For a lot of people who are at the end of their life, the last thing they want to do is to start worrying about their financial affairs. They want to be able to usually be in their own surroundings with their loved ones, not worrying about those things as well for them. So it may mean that you can pay off some debts. It may mean that you can keep the lights on in your home by paying your utility bills, putting food on the table when it's very unlikely that you'll be earning. What it also does is it perhaps gives you access to carers. We know that there's an issue with carers in the system now, that it's very difficult to get carers and perhaps get carers that will visit you enough times in the day to give you the kind of support that you potentially need at that time of your life. And it may also allow you to put some money in the hands of people who need to make arrangements for your funeral. And that kind of thing can be quite priceless, and it's giving giving you peace of mind at a time when emotionally things can be quite difficult.
I've heard stories of people being able to use that money to provide almost an income for a family member who's had to take a career break to help look after them. And I think that's a really good use of the money. I also like to think that there's something in, if you're well enough to be able to go maybe on a holiday and create moments, memories at the end of someone's life. That's really special. There's actually a lot of good to come out of this story today, isn't it?
Absolutely. I mean, money is money at the end of the day, Andy, but to you and I, we understand that money can lessen burdens and enhance your life in ways that may not be possible without it. So we can't ignore these benefits that exist within life insurance policies. We want to make sure that our listeners know about them so that if they have a family member or anyone going through this, that they perhaps probe them to look at their life insurance policies and see whether that benefit exists and whether they might actually be entitled to some money during their lifetime that would ease the pressures.
Harvey, thanks ever so much for coming on to the show again this week. And so moving on to the last piece of the pod then, and this is just a quick piece on, I mean, it's topical, isn't it? COP26 has been going on, and Damien, you were doing some digging around and found something you liked. You got quite excited, didn't you? You sent it to the team and we were having a play around with it.
Yeah, and you didn't get as excited as me, but that doesn't mean it's not going to be on the podcast. Now, what it was to do with is, like Andy said, COP26, and we'd seen lots about climate temperature targets and whether countries would adhere to them and whether there'd be some kind of agreement. Now, I was doing some research and I came full circle and ended up on a tool that I'd used before. But the reason I want to talk about it on the podcast, because the tool has evolved. Now, back on podcast episode 329, I talked about a ESG rating tool. It was by MSCI. Now, I'm not going to read the URL out. I'll link to it in the show notes. You can find it, and obviously on the episode page on the website. But the tool now has changed. There's been a new part added to it. So it's basically doubled in size. So previously you went on the tool and you could go and put in any company name. There's about 2,000 companies, in fairness, where you could search to see what their ESG ratings were. So that's their ethical social governance. And it would look at a whole range of different factors, including corporate governance, how they treat their employees, product carbon footprints, all these kind of things, and pull together a rating for them compared to their industry. So you could see an ESG rating for them. So effectively, it gave you a nice way to be able to look at companies. So you could put in somebody like Tesco, for example, or Ford Motor Company, and you get a rating, see how they compared to their peers in their sector, whether they were leaders, average, whether they were laggards, and then you could choose whether you might want to invest in them, use them as a company, buy products for them or not. And even if you don't buy shares directly, you could look at funds that you invested by looking at their fact sheet and see the top 10 holdings in that fund and see if you like the look of them based upon that tool. But what's happened is the tool has now changed, and they've actually included now an implied temperature rise measure. And what that does, I'm going to read it out to you. It effectively gives each company a temperature rating. And what it does, it compares the current and projected greenhouse gas emissions of all of these thousands of listed companies. And it's with reference to the global carbon budget for keeping global warming this century below 2 degrees centigrade. So you can read how they do it and look at the metric in more detail. But very simply, you can use the tool, put in a company's name, and you get a nice little graphic that's got like a thermometer that will be green, amber or red, and it will tell you what the implied temperature rise is for that company, and it will show you whether they are aligned with the 2 degree centigrade target, whether they're misaligned or if they're lagging. And of course it can show you if they're aligned with a much higher temperature rise, as much as like nearly 4 degrees. So just a very quick piece. Go and click on the link in the show notes. Start chucking people in there. Chuck in Tesla. You'll be surprised. Also chuck in Ford Motor Company. You'll also be probably horrified. There's a lot of car companies in there.
Nissan's worse, I think. I'll check those.
Yeah, so go and have and what it does is you start to realise that as consumers and investors, you are empowered through information that exists like this to see whether companies are on target to be able to meet some of these long-term temperature targets that are causing concern in regards to climate change. So you can make decisions on your investments and the things you buy based on this tool. Not every company will be on there, but it is empowering you as a consumer.
And so that's it for this week. If you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. We're on Instagram, Facebook, YouTube, all the usual places. And don't forget, please do review the podcast. We're due to read out some more reviews. We'll probably get to that next week. If you do that in the meantime, you may well get yourself a coveted Money to the Masses mug, and before Christmas too, so you could be slurping a lovely drink from a Money to the Masses mug.
Yeah, and don't forget to check out our Insta stories, because I'm all over that at the moment.
So, until next time.
Until next time.